It's often said that Bitcoin lags gold by about 3 months. If that's true, then gold's explosive rally at the end of 2025 should imply a powerful Bitcoin move at the start of 2026. But that assumption rests on a very simple idea: that capital rotates from gold into Bitcoin because Bitcoin is digital gold. The reality is far more complex. Today we're going to break down the true relationship between Bitcoin and gold, explain why the lag narrative is misleading, and uncover what gold's recent price action actually signals for crypto in 2026. This is a conversation you can't afford to miss. Welcome to Web3 Verse. Before we begin, a quick disclaimer. Nothing in this video is financial or investment advice. This content is purely educational and intended to help you understand the deeper mechanics driving markets right now. Now let's start at the surface and then go deeper. In theory, investors see Bitcoin as a safe haven similar to gold. Both assets have fixed supply, can be self-custodied, and exist outside direct government control. That's where the comparison usually ends. In practice, Bitcoin is still treated as a risk asset by most investors. Specifically, it's viewed as a high-risk, high-reward proxy for technology, often trading more like the Nasdaq than a traditional store of value. Even investors who genuinely believe Bitcoin is digital gold tend to treat it as a leveraged version of gold. That actually makes Bitcoin behave more like digital silver than digital gold, and that distinction matters more than most people realize. Silver has historically outperformed gold in speculative phases, and underperformed violently when risk appetite collapses. That's exactly how Bitcoin behaves today. Because of this perception, Bitcoin and gold often sit on opposite ends of the risk spectrum. Gold is a true safe haven. It has been trusted as a store of value for thousands of years across civilizations, political systems, and monetary regimes. Bitcoin hasn't earned that universal status yet. And once you understand this, the so-called lag between gold and Bitcoin begins to make sense. When gold rises, it usually signals fear. Investors are worried about economic instability, geopolitics, debt sustainability, or financial stress. That creates a risk-off environment, and in those conditions, assets like Bitcoin tend to struggle. When gold falls, confidence begins to return. Risk appetite increases. Capital flows back into equities, emerging markets, and crypto. This creates the illusion of rotation from gold into Bitcoin, but it's not about gold versus Bitcoin. It's about risk on versus risk off. And we've seen this dynamic play out over and over again. In early 2020, when the pandemic hit, gold surged while Bitcoin crashed. That was pure risk-off behavior. Then came massive stimulus. Liquidity flooded the global system. Risk appetite exploded. Gold peaked and fell in late 2020, while crypto entered one of the strongest bull markets in history, topping in early 2021 just as gold bottomed. The same pattern appeared again in late 2024. Gold weakened while altcoins surged to multi-year highs. And when gold resumed its rally, crypto rolled over. Not because gold was draining liquidity, but because gold was signaling deteriorating risk conditions in the background. So here's the critical question. What happens when gold's most recent rally ends? At first glance, you might expect a crypto rally. But history warns us that it's not that simple. Gold rallied into crypto market tops in early 2018 and late 2021. That tells us something deeper is at play. And this is where the analysis truly matters. Gold doesn't have a single demand driver. Its demand changes depending on where we are in the global liquidity cycle. Since 2022, central banks have aggressively accumulated gold, especially after witnessing reserves frozen during geopolitical conflicts. Gold re-emerged as the safest neutral reserve asset in the world. At the same time, private investors across China, the US, and Europe began reallocating into gold. In China, the property market collapsed, destroying what was once the primary store of wealth. In the West, bonds became unattractive due to inflation and fiscal risk. Stocks became increasingly concentrated, expensive, and fragile. Gold benefited from all of it. That fundamental accumulation pushed gold from roughly $2,200 in early 2024 to around $3,400 by mid-2025. But what happened next changed everything. From $3,400 to over $4,600, gold's rally was no longer driven by fundamentals. It was driven by speculation. Search interest exploded. Retail participation surged. Gold miners and silver, higher beta plays, went parabolic. Whenever high-risk gold proxies begin outperforming gold itself, it's a clear signal that risk on capital has entered the precious metals market. And this is the turning point. When risk-off investors dominate gold demand, gold rises while crypto falls. But when risk-on investors dominate gold demand, gold and crypto can rise together. That's exactly what we saw during parts of 2025. However, speculation doesn't last forever. And when leverage unwinds, it doesn't rotate, it liquidates. Which brings us to the real driver behind everything: global liquidity. Liquidity is simply the amount of money flowing through the financial system. And according to leading liquidity analysts, global liquidity likely peaked in late 2025 or early 2026. Here's the critical misunderstanding most investors make. Risk assets don't perform best when liquidity peaks. They perform best when liquidity is rising. Liquidity peaks tend to coincide with commodity blow-offs, especially gold. And sure enough, it's not just gold. Copper, coffee, and other commodities have surged as well. This is textbook late-cycle behavior. What follows a liquidity peak is a liquidity contraction, a scramble for cash. And the primary reason for that contraction is debt refinancing. Every 4 to 5 years, massive amounts of global debt must be rolled over. When that happens, assets are sold to raise cash. That selling pressure hits everything. Gold falls. Crypto falls. Stocks fall. Not because gold drives crypto, but because liquidity is draining from the system. The best real-time indicator of this process is the US dollar index, or DXY. When the DXY rises, demand for cash is increasing. And that's bad for all risk assets. Gold has a strong inverse relationship with the DXY. And with speculation dominating gold today, a rising dollar could trigger a sharp correction. If that happens, crypto likely falls alongside it. So what does all of this mean for Bitcoin and crypto in 2026? First, it explains why crypto didn't rally alongside gold in late 2025. There was a clear disconnect between crypto and global liquidity starting in mid-2025. Liquidity kept rising, but crypto stalled. Something broke. The most likely explanation is that structural damage occurred during the spring 2025 market shock, leaving crypto liquidity fragile heading into later volatility. Second, it helps frame what comes next. There may be a short-term relief rally in early 2026 as recent liquidity injections filter through the system. Crypto typically lags liquidity by about 3 months. That means Q1 2026 could still see upside. But after that, the larger liquidity contraction driven by debt refinancing is likely to dominate. That's when risk assets struggle again. The silver lining? Every liquidity contraction eventually forces policymakers to inject liquidity back into the system. And historically, those injections only arrive when markets or the economy deteriorate badly. That's why major stimulus events tend to mark market bottoms, not tops. When that next injection arrives, crypto will likely recover, once again lagging liquidity by a few months. Gold may bottom around the same time, just as it did in 2018 and 2022. And then the cycle begins again. Stocks and crypto lead. Commodities follow. Liquidity peaks. The wheel keeps turning. The key takeaway is simple. Bitcoin does not follow gold. Both follow liquidity. Gold is the signal. Liquidity is the driver. And understanding that difference is what separates narratives from reality. Thanks for watching Web3 Verse.